more on the next social media company to go public, planning to go public. We've been talking about it. Zynga. I want to bring in angel investor Bob Rice of Tangent Capital Partners. Bob, do you agree with Jim Chanos there?
Yes. How's that for an answer? Look, these valuations really are hard to swallow when you look at them from any sort of traditional financial metrics. Now, the good news about Zynga is that almost at any number, it could look like a value stock compared to LinkedIn simply because they are actually generating some pretty real numbers and they're demonstrating some real growth.
Right, real revenue.
Real revenue and, of course, real profits because the cost of goods sold on virtual goods is pretty low. So you do pretty well as long as you can continue to sell them. But, of course, there are numerous risks in this thing, including the risk of whether the underlying business model is really sustainable over the long term or whether you're just looking at a kind of a fad in terms of giving and receiving virtual goods.
Well, what do you think?
I think I'd weigh in a little bit more on the fad part of that. Now, look, the one thing that they really have figured out is how to make you pay for an apparently free game. And virtual goods is a big part of it. But they've got some other angles that are very clever, which is your character slowly runs out of energy as you play. And you can either wait and be patient for him to recharge, or you can use credits.
Right.
And get back into the game, right?
Yes.
So it's really a clever way of making you pay to play, and people are doing it.
Getting you hooked, essentially.
Yes.
Bob, last time you were on when we were talking about LinkedIn, you were saying, why does LinkedIn even need this money, right? Why do they need to raise hundreds of millions of dollars? Why would Zynga need to raise any extra money?
Well, you're exactly right again. None of these companies are capital intensive. They don't require the money in the same way that traditional industrial companies that went public did. Normally, people went to the public markets because they needed to raise a large amount of capital to build a factory or to do something.
Right.
That's not true here, and so obviously the motives are primarily financial. There's really no other way to put it, and you've got Kleiner
basically
Perkins.
That the founders and the investors, the venture capital companies, want to cash out.
Absolutely, and when they see what happened to LinkedIn, you can't blame them. I mean, they're looking at this thing and going, my goodness, we make a lot more money than those guys. Look what they went out at. Look what happened in the aftermarket. We got to jump in right now.
Bob, when you were talking about these valuations, I just want to point out to our viewers, I looked up the LinkedIn PE. 1,363.
No, it's just
what could possibly?
Nothing.
How could they possibly return that?
Nothing. They can't, and so those values. I mean, I'm always wrong, so you shouldn't listen to me. But those values have to come down.
That's true.
I think those values have to come down, and I think people have to really take a breath and realize that this is it's an interesting new development in the world of making money and the world of connecting people and the world of commerce. All those things are true. It's fascinating. It's great to be in early, but there still has to be some realistic financial anchor to the thing.
Right.
With respect to also Zynga, one of the most interesting aspects of this is this interrelationship with Facebook and what it's going to mean for Facebook over time, because investors are going to have to look very closely at the fact that a huge percentage of the use and a huge percentage of the revenues are coming from another company. In this case, Facebook, because that's
a vulnerability there.
It's a very big vulnerability for Zynga. The flip of it is it's a little bit of a vulnerability for Facebook because there's going to be a huge impetus now for Zynga to get off the Facebook platform as rapidly as possible. The investors are going to demand it. And that's a big chunk of the user base of Facebook and a big chunk of the revenues at Facebook. So it's a very interesting sort of contest and conflict between the two of them. In fact,
dynamic, yeah.
It's actually a conflict, and it was recently described by one of the Kleiner Perkins guys as the tech equivalent of the Cuban Missile Crisis.
How so?
Hilariously, at some period of time ago when they were really at odds about whether or not you were going to use Facebook credits or Zynga credits in the games. So this kind of tension is going to have to be resolved in a clear way, from my point of view, for this IPO to move.
Right, and for this company to basically get to that next level. Bob, do you think that we are, in fact, in a tech bubble here?
I think it's hard to say no to that question, and I'm seeing it all the way back down, right to the very startup phases. You're getting back to the days now when people are showing you a business plan on the back of an envelope and expecting to get $1 million minimum valuation, and even the real companies that were going out at $2 or $3 million in pre-money, the early stage angel ventures, are now asking for $6 or $8 million. So you're seeing it all the way up. And another place you're seeing it, and you're going to continue to see it, is in these pre-public exchanges like Second Market and Shares Post. And I can't imagine what's going to happen to the Zynga shares, which are being traded there right now, in light of this news.
Bob, great to talk with you as usual.